All right, let's settle a classic debate, one that comes up all the time. You're ready to invest, but you're kind of stuck between two heavyweights. In one corner, you've got the legendary S&P 500, the absolute titan of growth. And in the other corner, we have the high-income hero, the Real Estate Investment Trust, or what we all call a REIT. Both of them claim to be the best way to own a piece of the American economy. So, which one actually wins? Well, today we're going to forget the hype and just let the math decide.
You know, the choice really boils down to this one crucial question. Are you trying to build a portfolio for the biggest possible long-term growth? Or do you need that portfolio to start generating a steady stream of cash for you right now? See, those are two completely different jobs, and they're going to lead you down two very different investment paths. So to find our answer, we're going to break it all down. First, we'll introduce the core ideas. Then we'll dive into each of our contenders, put them head-to-head in a 10-year math showdown, and finally, help you figure out which champion is right for your portfolio. Okay, so let's properly introduce the two philosophies that are squaring off today, because this isn't just about stocks versus real estate. Nope, it's about two fundamentally different ways of thinking about how your money should be working for you. Here is the absolute simplest way to think about it. When you invest in the S&P 500, it's like you're owning a tiny piece of America's 500 biggest businesses. You know, the innovators, the industry titans. But when you invest in REITs, it's like you're their landlord. You own the actual buildings, the warehouses, and the data centers they need to operate. So first up, let's talk about the titan of the investment world, the S&P 500. Its entire design, its whole purpose, is geared towards one thing: growth. The brilliant thing about an S&P 500 index fund is just how simple it is. With one single purchase, you own a piece of 500 dominant companies. That's instant diversification. And the strategy is famously passive. You just set it and forget it. The goal is super straightforward, for the value of your shares to go up over time. That's what we call capital appreciation. And this is the magic number. Historically, the S&P 500 has delivered an average annual return of around 10%. That is the fuel for its growth engine, and it allows what Einstein called the eighth wonder of the world, compound growth, to just work its magic over decades. So here's the bottom line. The S&P 500 is a machine, and it's engineered for one job: to create the largest possible pile of money at the end of your investment journey. It's all about that final number.
Now let's turn our attention to the challenger. REITs, well, they operate on a completely different principle. It's not so much about the finish line, it's about the cash you collect along the way. This is the cash flow machine.
REITs give you the power of real estate ownership, but without any of the headaches of tenants and toilets. You can own a whole portfolio of apartment buildings, vital data centers, or massive warehouses. You're investing in real, tangible, physical assets. And the main goal isn't just for the price to go up. It's about generating a consistent, high-yield income stream from all the rent being collected.
And here is the rule that forces them to be so focused on income. By law, REITs have to pay out at least 90% of their taxable income to shareholders in the form of dividends. This isn't a suggestion, it's a mandate. And it's the core reason their dividend yields are often so much higher than pretty much the rest of the market.
Okay, now this is where a lot of investors get tripped up. You might look at a REIT stock chart over, say, 5 years and notice the price hasn't really moved much. And you might think, wow, that was a terrible investment. But that's falling right into what we call the total return trap.
Because that stock price, that's only half the story. If you ignore the dividend, you're missing the entire point of owning a REIT. Your true return, your total return, is the price change plus that steady stream of dividends. You absolutely have to account for both.
All right, it's time to run the numbers. Let's put these two champions in the ring for a 10-year showdown. We'll imagine we start with a hypothetical $25,000 investment in each one, and we'll just see where they end up. So in a typical 10-year stretch, if we're just looking at the total value of the account, the S&P 500 often comes out ahead. Its relentless focus on growth and capital appreciation usually means you end up with a bigger pile of money. For a younger investor who has decades to let that money compound, this is an incredibly powerful formula. But wait, that's only one side of the coin. If we switch our focus from the total value to the annual income the portfolio generates, well, the roles are completely reversed. In this arena, the REIT is the undisputed champion. It produces a much larger stream of usable cash. For someone who's in or near retirement and needs their portfolio to actually pay the bills, this is the number that matters. So, after our big math showdown, who's the winner? Well,
The truth is, the verdict is yours. There really is no single best investment. There's only the one that is best for your specific financial goals. Let's just boil it all down to its core. The S&P 500 is laser-focused on that end goal, the final destination of maximum appreciation. A REIT, though, is focused on the journey. It's about providing you with a steady income that you can use along the way.
So here's how you pick your champion. If your number one goal is maximum growth, the S&P 500 is your fighter, hands down. If you need maximum income, say for retirement, REITs are literally built for that job. And, it's worth thinking about the tax difference, too. The S&P 500's growth is often taxed at lower capital gains rates when you sell. REIT dividends, they're typically taxed as ordinary income, which can be higher. But if you need that cash flow now, well, that's the trade-off you make.
And that leaves us with one final question. We've laid out all the math for you. One is a growth engine, the other is a cash flow machine. So take a look at your own financial life and just ask yourself this. What job do you need to hire your money to do? The answer to that question will tell you everything you need to know.